Hi, and welcome to your first video lecture this week. I hope that things are going well in Pullman. So let's go ahead and get started with the lecture, which covers Chapter 31 today. Before you begin, there are some things that I want you to know. First off, this lecture covers an entire chapter. You are encouraged to pause frequently and even stop the lecture and start again later. Usually in class, I do about half a chapter per lecture. The lecture tends to run slower because I ask and you answer questions. This gives you time for better understanding. If you do not understand a topic covered in the lecture, please pause the lecture and start again after referring to the book and getting a little bit of understanding. Next thing, you should be taking notes in the same manner that you do when we have a live class. It is important for you to write down the material and not simply try and rely on memory when recalling the information from the lecture. So please take notes just the same as we always do. And finally, there will be a quiz for you to complete after viewing this lecture in its entirety. Please make sure that you've gone through the entire lecture before viewing the quiz. Again, I want to caution you that because you're not pausing to ask me questions and I'm not stopping to ask you questions, this lecture will move a lot faster than the lectures that we normally do in class. So, with that, we're going to start Chapter 31, which is Money, Banking, and Financial Institutions. So, first topic is money. Most of you should have some concept of money, and I hope that all of you have used money so far. So, what backs the money supply in the United States? Take a moment to actually think about this. How does the money here in the United States, or any other country for that matter, get its value? Well, some countries use a gold standard or other things to back their money. In the United States, the money is guaranteed by the government's ability to keep the value of it relatively stable. Nothing more. So if you think of times or places or countries where money value has declined because they've experienced rapid hyperinflation or there's concern over the government's ability to control the money, then that money value declines. We saw this in our own country during the Civil War. The currency for the Confederacy became worthless because there was no way for the Confederacy to back the money supply. So, let's look at some of the functions of money. First function of money is that it needs to be a medium of exchange. This means that you can use money to exchange for goods and services. If you can remember back to the example that we did when we had the barter system and I brought 3 volunteers up to the front of the class, I gave them candy and told them they had to trade, but they couldn't trade. Okay, this is how you get around that situation where you have something and somebody else has something, but you can't trade because neither of you want that thing. You can trade for money. So money acts as our medium of exchange. The next thing is that money acts as a unit of account. It's a way of keeping track of how much you have. So when you borrow money on a car and you're making your car payments is not 1/20th of a car, it's $120 or $230 or whatever it is. So you use money to keep track of the value of the things that you've got going on. Which brings us to our next concept. Money is a store of value. Money is a great place to store up your value. So you can store value in other things. Some people use a store of value in real estate. Some people could use a store of value in antique sewing machines. But the problem with either keeping your money in real estate or in sewing machines is that it's incredibly difficult to access if you actually have a need for money because you have an emergency, you need to pay medical bills or something like that. That brings us to a concept known as liquidity. Liquidity refers to how easy it would be to convert an asset value in cash. The more liquid something is, the easier it is to convert into cash. So if someone were to store up all of their money value, or all of their value, all of their wealth, in sewing machines, particularly antique sewing machines, it wouldn't be highly liquid because it would be very difficult to find a dealer that would want antique sewing machines, and so it would be hard for them to get that into cash. So while antique sewing machines would be very difficult to convert, something like a money market mutual fund, stocks, or bonds are highly liquid because they're very easy to convert to cash. So let's look at the different components of the money supply. Our first component of the money supply is money itself, and the Federal Reserve calls this M1. M1 equals currency plus checkable deposits. By currency, we mean coins and paper money. Paper money is known as Federal Reserve notes. In fact, if you get $1 out of your pocket right now and look at it, it would say Federal Reserve note on it. Our coins and paper money are what is known as token money. This is money whose value is unrelated to its intrinsic value. So, if you've still got your dollar in your hand because you were looking to see if it said Federal Reserve note, there's not a lot of value that the dollar itself offers. Okay, it's not really good for anything. It's just a small piece of paper. It's not even good for writing on because somebody has already printed all over it. About the only intrinsic value your dollar has is the value that you could get from the heat it would generate when you would burn it. Okay, so the money, the dollar, has value either in $1 denomination or $20 denomination. It has nothing to do with how valuable itself is. Okay, you could have commodity money where the money would be sugar or tobacco. Those things have value because you can use tobacco to smoke or you can use sugar to bake. They have a value, whereas the money, there's really nothing there except for you could burn it. Again, this goes back to the concept of only money has value because the government has backed it. There's really nothing else to the money to make it valuable. The other part of this is checkable deposits. Checkable deposits are those deposits in a checking account that can be rapidly converted to money. So money is something that you can exchange for goods and services. Your deposits in your checking account act as money when you write a check or you swipe your debit card. You are immediately exchanging those for goods and services. So that gives it the same value as what we call money. So again, currency and checkable deposits are known as money in our M1 money supply. The next part of our money supply is what we call near money. This is the M2 designation of money from the Federal Reserve. It includes all of the money from M1, your currency and your checkable deposits, plus near money. Near money is a highly liquid financial asset that does not function as a medium of exchange, but can be readily converted to money. An example would be your savings account. Okay, so you can swipe your debit card and immediately buy something. But if your money is in your savings account, then there is an extra step between you and your ability to purchase that good or service. You would have to either call the bank and transfer the money into the savings account or go to the bank yourself and withdraw the money from the savings account. It's near money. It's there and it's highly liquid, but there's just one step between you and the goods and services that you desire. Another form of near money is money market deposit accounts and money market mutual funds. Again, they're highly liquid and easily converted into money. And the final aspect is time deposits less than $100,000. Time deposits are typically considered certificates of deposits. These are money that has to be put in the bank for a specified time. It could be as little as 6 months or as much as 5 years. So if I were to get a CD from a bank for 5 years, I would give them my money. They would give me a paper that says for this interest rate, you will get this interest rate for 5 years. Okay. The reason time deposits less than $100,000 are considered near money is that you can easily convert those into money. All you have to do is pay a fee, but there isn't a waiting period. If your time deposit is greater than $100,000, there's an additional waiting period in order to acquire the money, which means that it is no longer near money. So those are our components of the money supply. M1, which is our money, and M2, which is our near money. Now let's look at how our money supply is distributed. So I promised you before I left that there would be no graphs, and you will not be required to recreate this chart on a test. However, I do want you to understand the information contained in it. And actually, I'm going to give you a minute here to write about it. So our money supply, I've listed out all of the different types and their percentages. So right here, currency, and I'm hoping you can see my little pointer thing. Currency makes up about 10% of our money supply. Checkable deposits make up another 10% of our money supply. Currency and checkable deposits, the two of them together, make up what is known as our M1 money supply. So M1 money comprises about 20% of the total money out there. So where does the rest of our money, our M2, come from? As you can see, the majority of it here is savings deposits, including money market accounts. That's 57% of the money in savings accounts. An additional 9% is in a money market mutual fund. This is different than a money market deposit account. A money market deposit account acts more like a savings account, where money market mutual funds actually contains shares of stocks and mutual funds. So 9% of those are in money market mutual funds. The remaining 14% are those small time deposits less than $100,000. Now, when we're talking about money supply and having money in a savings account, the important thing to remember from our previous section is that all of our savings equals the investment of a business. So, all of this money here is supposedly used by businesses. Savings equals investment. When we put money in our savings account, this 57% held in savings, the banks are taking that and using it to make loans for cars, automobiles, new factories, machinery, equipment, and other things. So savings equals investment. The money doesn't sit in the bank, but continues to circulate in the economy. I put money in, they make a loan, and the money goes out, and then that will be deposited into somebody else's account. So the money circulates. Okay, next, let's look at some of the uses of money. First thing is that money can be used as debt. So if you continue to look at your dollar, unfortunately these dollars show the back and not the front, you will find a line on the dollar that says this is a legal tender for debts, public and private. So if I'm paying back that car loan, I don't say that I still owe 4/9 of a car. I can say that I still owe $5,000 on a car. The next thing that gives money its value is that it is acceptable. So money is only value because we have generally agreed that it's an acceptable form for a transaction. We could all deal in yellow markers if we all agreed that yellow markers were going to be acceptable to everybody. I personally believe yellow markers suck because nobody can see them past the front row. In fact, I think it's questionable if the front row could even see a yellow marker when I write it on the board. So, yellow markers are not acceptable, money is. Anything that is generally acceptable to the majority of the population can function as money. So if you think about other things that are acceptable, Bitcoin would fall into this category. The other thing is it's legal tender. The bill says this is legal tender for all debts, public and private. This is the form of money that the United States government has said that they're going to use to accept for debts, public debts. That's what it means, public and private. So debts to the government, they accept money, or at least this form of money. Okay. The other thing that gives money its value is its relative scarcity. Okay. If money were as numerous as the leaves on the trees, we would have hyperinflation. Inflation would skyrocket, prices would rise rapidly, and we wouldn't be able to afford anything. Because money is relatively scarce, that gives it its value. So think about how many ones there are versus how many 20s versus how many hundreds, okay? So you'd need 100 ones in order to come up with the value of a $100 bill. A $100 bill is more scarce than the $1 bill. Its relative scarcity helps to add to its value. If the Federal Reserve were to start printing money and money became more plentiful and less scarce, then we would again see inflation in the economy. The dollar would have less value because there were more of them available. Next, let's look at money and prices. We can use money in determining prices in different markets based on the purchasing power of the dollar. This is affected by inflation and deflation. When there is deflation, the dollar becomes relatively more valuable, whereas when there is inflation, the dollar becomes less valuable. Hyperinflation diminishes money's acceptability. So there are examples of countries recently who have retired their currency because there was huge amounts of inflation, and so you couldn't afford whatever it was. You'd have to have a wheelbarrow full of money to buy a loaf of bread. An example of extreme hyperinflation would have been in post-war Germany, where you literally did need a wheelbarrow full of money to purchase basic staples like milk, eggs, or bread. So hyperinflation reduces money's acceptability. Why would I want to accept money from you if it's going to be worth even less tomorrow? I might want something else in form of payment. Okay. The other thing that we can use money for is to help stabilize the economy. So, monetary policy, which is what we're studying this week, is the regulation of the nation's money supply and its interest rates. This is in contrast to fiscal policy, which is what we covered last week. Fiscal policy is the actions of Congress regarding the nation's budget, discretional spending, and the taxing systems. So, fiscal policy comes out of Congress, whereas monetary policy is controlled by the Federal Reserve, and we'll talk more about them on the next slide. So, the Federal Reserve and the banking system. The Federal Reserve System is the United States monetary authority whose major goal is to control the supply of money. The Federal Reserve is made up of a number of different parts. The first component of the Federal Reserve is the Board of Governors. This is made up of 7 people who are appointed by the President to serve 14-year terms. By appointing them to 14-year terms, that means that they are outside of the influence of the political business cycle. If our Board of Governors were appointed for shorter terms, they might be subject to the fluctuations in the political business cycle and having to worry about appointments being rescinded or made based on what's going on in the economy. By appointing people for 14 years and removing them from the political business cycle, they can focus on doing what is best for the economy without having to worry about what's going on with elections. The next portion of the Federal Reserve System is the 12 Federal Reserve Banks. Collectively, they are known as our nation's central bank, even though there are 12 separate banks, each representing a different district. Our district bank is San Francisco. Okay. These banks are what is known as quasi-public banks. This means that they have both private and public control. While the government sets up the Federal Reserve banking system, which is the public control portion of it, all of the private banks must participate in the Federal Reserve System as well. The Federal Reserve System is known as the banker's bank. So when a bank wants a loan, they would go to the Federal Reserve Bank. An example of this would be if Wells Fargo needed to borrow money, as does occasionally happen, they would go to the Federal Reserve to borrow that money. The next component is what is known as the Federal Open Market Committee, which in economics we call FOMC. This is comprised of the 7 members from the Board of Governors, along with the president of the New York Federal Reserve Bank, and 4 of the presidents of the 11 other federal banks on a rotating basis. So the president of the Federal Reserve has a permanent, or the president of the New York Federal Reserve has a permanent seat on the Board of Governors. The remaining presidents rotate in and out. And the final component of the Federal Reserve System is the commercial banks and thrifts themselves. So commercial banks are generally what you're familiar with, like Wells Fargo or Citibank. A thrift is a savings and loans institution. So Washington State Employees Federal Credit Union would be a thrift versus a commercial bank like Umpqua or I don't know, U.S. Bank. So those are the components that make up the Federal Reserve System. Now let's look at the functions of the Fed. The first function of the Federal Reserve is to issue currency. So they control the supply of money. They print money all the time. You may not have been aware that the Federal Reserve also destroys money. If you've ever gotten a dollar that looks more than a little ragged, you can be assured that when it gets to the hands of a bank, that would be pulled and sent to the Federal Reserve where it's shredded. You can actually buy bags of shredded dollars from the Federal Reserve if you ever visit. So not only do they print money, but they also bring back the currency that has been destroyed and shred that and destroy money as well. The next function of the Federal Reserve is to set the reserve requirement and to hold reserves. The reserve requirement is the portion of reserves that banks are required to hold. I think maybe a better way to say that is when you make a deposit to a bank, banks are required to hold a portion of that deposit, not the whole deposit. So if you were going to deposit $100, a bank might only hold $10 of that and make the remaining $90 into a loan for somebody else. Okay, so the Federal Reserve sets the requirement for how much money of your deposit the banks actually have to hold. The next function of the Fed is to provide lending to financial institutions and act as the lender of last resort. Okay, so when Wells Fargo needs to get a loan, they go to the Federal Reserve. The next function is to provide for check collection. So I don't know how many of you actually still write checks, but once upon a time, when you wrote a check, that would have to clear the Federal Reserve Bank. This is why it takes checks longer to clear than it does your debit cards, which are done electronically. So, way back, once upon a time, I would write a check. It would go to whomever, like say I wrote a check to my mom. She would take it to her bank. Then they would have to send it all the way to San Francisco. And San Francisco would collect all the checks that needed to go back to my bank. And then in my statement, it would be really thick because I would get back every check that I wrote. So Federal Reserve provides for check collection. Now, thankfully, we're able to do it electronically so you don't get a huge envelope full of all the checks that you wrote. Also, the Federal Reserve acts as a fiscal agent. They provide financial services for the federal government. When the federal government receives tax revenue, they need a place to deposit that. The Federal Reserve is the bank for the federal government. Okay? When the federal government needs to pay a debt or write checks for Social Security, the money is transferred from the Federal Reserve to the agencies that need it. So basically, the Federal Reserve is the government's bank. Also, the Federal Reserve is required for supervising banks to ensure that they are following rules and regulations to make sure that they are not harming consumers or engaging in risky practices. The final function of the Federal Reserve is controlling the money supply. So in addition to issuing currency, there are other ways to control money, which we'll go over in the next chapter. But basically, you can encourage a bank to hold money by raising the reserve requirement, or you can encourage a bank to loosen their money supply by lowering interest rates or lowering the reserve requirement. So in addition to issuing and destroying currency, they can also, through their policies, encourage banks to either hold or give out more money as well. Okay, we had a huge financial crisis that led up to the current recession in the years of 2007 and 2008. And your book offers an entire section in their chapter on that. So let's start with the mortgage default crisis. This happened when a number of companies were issuing what's known as subprime loans. A subprime loan is a high-interest loan made to people who are high credit risks. So an example would be somebody who is not what we would call credit worthy is still able to obtain a loan through the subprime loan process. An example that I know of in Moscow is a man worked an 80-hour week and again, this was in 2007 before the crash, he worked an 80-hour week and took his pay stub into the bank and said, I want to buy a house and this is my income. Okay, he wasn't a particularly good candidate for that, but all he had was the one bank stub, and they said, okay, yes, we're going to make a loan based on this. So when you make loans to people who are high credit risk, then they have a higher rate of defaulting on those loans. The reason banks were willing to make subprime loans and make loans to those people who were high credit risk was because of a function called the mortgage-backed security. These are bonds backed by mortgage payments. Typically, mortgage payments were a very stable, very sturdy, very, very safe investment because people didn't want to lose their homes. They wanted to pay that mortgage off so that they could own their home. But when you start making subprime loans with higher credit risk, people are more likely to default. These mortgage-backed securities, they took the bonds from the mortgage payments and they sold bundles of the loans on the stock market. This meant that the banks were no longer holding the risk. They were making loans to risky people, bundling all of those loans together and selling them on the stock market. Okay, this brings us to a point called securitization. Securitization is the process of slicing up and bundling the loans. This was viewed as very favorable because banks could lessen their risk. If banks had less risk, they were supposedly less likely to fail. Unfortunately, all of those bad loans did start to fail, and then you were left with sorting out, well, who owned it? Because if I owned a portion of these bundles, I might owe 6%, somebody else could owe 9%, somebody else could own 2%. And so if everybody owns a different percent, you can't really figure out who's going to take the loss for the default. So it became very difficult to sort out. The other thing that happened with the financial crisis is failures and near failures of firms. If you can think back to the example I did where I said, okay, I think I started with Jose and I said Jose was going to get a loan for $5 and then he was going to loan it to John because John was going to promise to pay him back $6. And then I went across the aisle, I think it was to Gregorio, and he was going to get the loan for $5, but then he had to pay John back $7. As this continued down the line, when the guy at the very end failed, that caused a chain reaction of everybody up the line to also face failure or near failure, and the government ended up bailing out a lot of banks. So that brings us to the Treasury bailout, which is called the Troubled Asset Relief Fund. In 2008, Congress allocated $700 billion to the U.S. Treasury to make emergency loans to banks so that they would not fail in the run-up to the recession. And this is actually one of the points that caused the recession, is because when the guy at the very end didn't repay his loan and it caused trouble all the way through, they said, if the government had not made those loans, companies like McDonald's would not have been able to make their payroll that week. That's how close we were to a financial crisis. So all of this brought about a series of Wall Street reforms and a brand new Consumer Protection Act. This gave broader... I'm talking to my class. I'm doing my video lecture. Okay, so the Consumer Protection Act gave broader authority to the Federal Reserve to regulate both banks and thrifts. It also allows the Fed to sell off assets of failing financial institutions. Further, it provided oversight on mortgage-backed securities. So this made it easier to track all of those securities that were bundled, and they actually had to have some oversight on those securities as well. And finally, it required the companies, oops, that should be an S, selling assets backed by securities to hold a portion of those securities. Okay? So if you were going to sell mortgage-backed securities, you actually had to hold some of the risk. This actually makes companies less likely to make those high-risk subprime loans if they have to hold the loans and take some of the burden and the risk for themselves. So, end notes. I know this was a lot of information, and I know it went really fast. I would recommend that you rewind, go back, and review information. Like I said, if you needed to, I hope you paused in order to write down the information before I continued talking. So, I want to draw your attention to a couple of things before we say goodbye. I want you to review Table 31.1 in your book. It's titled Major Categories of Financial Institutions Within the U.S. Financial Services Industry. It's Table 31.1 in the full version of the book. I don't know what table number it is in the half version of the book. So if you have the half version, the macro-only version of the book, get with somebody who does have the full version and look up page 650 to see that table so that you can go over it, review it as well. Those are the kinds of things that could potentially show up for vocabulary term questions. Also, I want you to take the quiz following the completion of this lecture. It's short, it's between 3 and 5 questions. It counts as a regular quiz, but you need to have watched the lecture first. And also, don't forget to do your homework. It's due Friday, and you will be turning it in on paper. So, hope you've enjoyed this. I will see you next week.